The Treasury bond market may still be underpricing structural inflation risks. So we got negative term premium here on the 10-year. That's definitely something to be aware of. If you had much higher inflation, as we'll talk about in the next section, structurally, you're talking about the mean 10-year term premium in the Treasury market on the 10-year tenor is 150 basis points positive. We're at minus 18 basis points negative at the current juncture. And then if you look at the 10-year tips break evens, or the Cleveland Fed's 10-year expected inflation rate, those numbers are right around kind of 215-ish there. You're talking about numbers that could be 100 basis points higher if we have if the inflation genie does not get put back in if the economy soft lands in a year or 2 years from now, the inflation bottomed at 2% and is at 3 or 4%. These numbers, term premia, break evens, and market implied inflation expectations, those numbers will be headed higher over the long term. And that's certainly something that could happen. We're just not saying you need to position for that today. A lot of folks will do the research, come up with an investment thesis and put the position on immediately. You don't need to do that. Separate your risk management from your research. Only put positions on when the signals, the quantitative risk management signals, are telling you it's a good time to put those theses to work. And when the quantitative risk management signals tell you it's a good time to book gains or even cut losses in that thesis, that's when you do that. That's why you keep those processes separate, because it helps you stay on the right side of market risk. It helps you, Mr. Buy-Sider, stay in your seat so that we can all feed our families.